Hello everyone, I'm Brandon Garrett with Ben Oak Capital with a special market update due to recent market volatility. Please stay tuned at the end of this video for a required disclosure statement. The silver linings might be hard to see right now as spring approaches, clouded by war in Ukraine. Democracy is under attack and innocent lives are tragically being lost. But while we keep one eye on overseas developments, the other remains squarely focused on the fundamentals of the U.S. economy and the stock market to help investors stay the course. Geopolitical uncertainty can be tough for investors to manage. The natural impulse for many is to sell, which history clearly shows is usually poorly timed. As difficult as it may be to see the silver linings through the fog of war, these periods usually end up representing good buying opportunities for investors, or, said another way, not ideal levels to sell out. Stocks have historically proven to be quite resilient to major geopolitical events, and this time shouldn't be an exception, even if the wait is uncomfortable. Over the past 70 years, only 3 major geopolitical events took the S&P 500 index more than 9 weeks to recover its post-event losses. 1. Pearl Harbor. 2. The breakout of the Korean War. And 3. Iraq's invasion of Kuwait. Looking at all major geopolitical events since World War II, the average post-event loss for the stock market has been just 5 to 6%, with an average recovery time of less than 7 weeks. It's important to note that most of the recent correction actually occurred in January through mid-February prior to the Ukraine invasion. Markets have remained volatile since then, but have mostly been trading within a range. The war in Eastern Europe will, however, carry an economic cost for the United States. Although U.S.-Russia trade is minimal, we use very little Russian oil, and our banks hold a negligible amount of Russian assets, higher global oil prices will be felt by U.S. consumers. But we don't think it will be enough to stop consumers from spending, especially as COVID-19 restrictions disappear. For Europe, the cost will be higher due to the continent's greater reliance on Russian energy, so steering investments away from Europe and more toward the U.S. makes sense for now. This is a tough time for everyone as compassionate human beings and as investors. Russia's aggression is unsettling, and the images of the crisis in Ukraine are disheartening. Ukraine's resistance is inspiring, and we pray for the country and its people. While it's impossible to know how this conflict will play out, the long-term outlook for the U.S. economy and corporate profits remains bright. Stocks have become more attractively valued following the latest correction. Interest rates remain low. The Federal Reserve will likely now take a go-slow approach with its rate hiking campaign, and markets have historically proven resilient to major geopolitical events. Our recommendation is to be patient and stick to your plan. That's it for this month's video. If you have any questions about what we discussed, please give us a call. We'd be happy to talk to you.